Coming hot off the heels of a jobs report that saw dour jobs growth coming into play once again for the US. Of course, the pressure is on Jay Powell and the Federal Reserve to act, but there's one major hurdle left before that FOMC meeting, and it comes in the form of Thursday's CPI report. We also see PPI on Wednesday. In this video, I'm going to guide you through exactly what the underlying metrics are looking like at the moment, the things that could factor in when it comes to the CPI release, and also the potential implications around these announcements on the likes of the US dollar, the likes of gold, and the Nasdaq. So first and foremost, we can see here that the outlook for PPI is 0.4. It comes off the back of a monthly reading of 0.9. Certainly shocked markets last time around, but there's a question mark about how much we need to really care about this. It's certain that PPI is not the key metric that everyone's looking out for to guide monetary policy. By and large, that'll be the likes of the core PCE figure, the likes of the CPI numbers. But certainly PPI coming in that hot does point towards a potential for inflation to be feeding through into sort of factory prices that will ultimately lead to higher consumer prices. We're not quite there yet, and you can see in terms of the consumer prices, 0.3 expected on monthly readings for both headline and core inflation currently running hot at 3.1, and the headline number currently at 2.7, but an expectation of further upside to come, moving into 2.8%. As we can see here, essentially the Federal Reserve have two areas to look out for. It's unemployment, so they want full unemployment. They don't want to see a surge in terms of unemployment. If they do, they'd need to act. And they also want to see inflation under control. The core PCE price index is the main port of call, but the CPI numbers are certainly very important unto themselves. At the moment, both unemployment and inflation look like they're kind of bottoming out. Are we going to see a resurgence in one or the other? Well, that remains to be seen, but certainly inflation, if we were to see a significant surge, could undermine the pathway lower in terms of interest rates. There's question marks about whether the Federal Reserve would just look through near-term price pressures and say that it's temporary because of tariffs. But nonetheless, markets, by and large, I think would be less confident of interest rate cuts if we were to see a significant surge in terms of price pressures. Talking about the jobs report, on Friday, we saw a 22k payrolls figure coming out. Now, that really feeds into the recent narrative around continued weakness in the jobs market. We saw weakness in terms of the challenger numbers, the JOLTS numbers, the ADP numbers, and then the headline jobs report. Higher unemployment, lower payrolls, 22k coming in. And as we can see here, the initial numbers have been bad, but the final numbers have been even worse once you see the downward revisions coming into play. And we did see a downward revision this time around as well that certainly made things look pretty ugly for a couple months ago. Now, this is particularly notable as well. What I've done here is I've taken the payrolls and I provide this sort of sector specific view so you can see where these jobs are coming from. What I've done is I've taken out the healthcare sector and tried to see exactly how things look if we don't have that factored in. And as we can see here in terms of that orange line, we're in negative territory. So negative growth, the only real area of strength recently has been healthcare. And so, this is certainly not, when we're looking at sort of month-on-month increases in terms of jobs, this isn't something that's widespread. Most of these sectors are in negative territory at the moment. The healthcare sector has been playing a significant role in propping that up. You remove that, and certainly the US economy does not look good across the board in terms of the breadth of job creation. This is the US CPI on a 3-month annualized, 6-month annualized, and a year-on-year basis, and then overlaying that with the ISM prices, elements from both services and manufacturing. And then I believe I've provided a 6-month lag. Generally, there's a lag between those PMI numbers and actually feeding through into CPI. So we're at the point where really we need to see prices pick up, or else we start to think that the respondents within those PMI surveys are more sort of basing their responses on sentiment rather than the actual prices coming through, or else those prices came through hot and they came down swiftly, which you can see in terms of manufacturing, it has started to come down, or else they've come in hot, but they haven't passed it on to consumer. So different ways of it playing out that potentially means that we don't see prices increase, but certainly we've come to the point where if it is going to increase, it needs to start to increase now. Now, there's also a caveat here that is that when we first started hearing about these tariffs, it looked awful. Donald Trump kept so-called tacoing it out. He kept pausing and delaying, and he doesn't really want to lift inflation. He doesn't really want to enact many of these sort of hardcore tariffs. He doesn't mind doing the odd 10, 15% here and there. So it remains to be seen as to whether many of these responses actually were an indication of how things look like they were initially shaking up, and they've not necessarily worked out to be as bad as many had anticipated. In terms of monthly inflation, as you can see here, I've got CPI, core CPI and core PCE. And you can see that we have gradually been increasing, but we're sort of more going from the sort of 0.1 mark up to 0.3 for the month. It's above where we want to be, 0.3, but as long as we're there or below, it's not necessarily a massive problem. But arguably, we want to be around the 0.2, maybe a little touch below that level to get towards that 2% target. But yeah, we have been seeing some increases over recent months, but not enough for the Federal Reserve to sort of cancel the rate cuts that look like they need to come into play. And then I wanted to highlight the sort of role that crude and energy prices has been playing in all this. And you can see here I've added a 1 month lead because it takes time for prices to actually then feed through into, say, the pump, and then consumers are impacted by it. But you can see here there's a pretty decent correlation between the 1 month CPI reading and the movements within WTI. And so the downside that we have been seeing, the depressed nature, does provide the basis for inflation in the headline nature, at least, to remain under control. It's been heading lower of late, and that provides a potential downward pressure on inflation over the near term. In terms of market expectations, what we can see here is that markets are 90% sure we're going to see a 25 basis point cut, according to the CME. 10% remaining point towards a 50 basis point cut. One thing is certain, everyone thinks we're going to get a cut in September. That, of course, means that it's swung entirely in one direction. And so in terms of the pricing, if we see inflation coming in really low, then you probably see additional pricing for a 50 basis point cut. Potential for weakness in terms of the US dollar, strength in terms of gold, and possible strength in terms of equities as well. The flip side is if we see inflation coming in hot, it would probably ease back on some of these expectations, point towards less rate cuts over the near term. Maybe instead of 3 rate cuts for the remaining 3 meetings this year, maybe it moved back towards 2. Certainly last week before the jobs report, that's how it was looking. The base case scenario was for 2. Now we've moved into 3 out of 3. And so the sort of shifts in terms of the narrative of the pace of timing is going to be key here, because at the moment, really, markets are very confident that we will see a cut in September. So whether we see a cut in September or not, that's not really the question here. The question is, do we see a 50 basis point cut? At the moment, that's just a 10% outside chance being factored in. But then crucially, what's the pathway from there onwards? And markets currently price it at 3 cuts from 3 meetings for the remainder of 2025. Then coming into 2026, we see a potential pause. It's near basically 50-50. And then a sort of cut every other meeting, essentially. That's market expectations as things stand. But of course, these change, and they change around the data, and the data will be key this time around. Now, in terms of the chart, let's start first and foremost for gold, because we've hit yet another record high. And that comes off the back of the breakout from the symmetrical triangle, which worked out perfectly. We broke through resistance trend line, broke through your initial horizontals, and then we've just been hitting one after the other, and then hitting record highs. More recently, sort of coming into this phase where we're coming back towards this sort of trend line support time and time again. At the moment, we've pulled back into what was resistance, the prior high, and then found support off that, broke into a new high. Now we're starting to see a little bit of a pullback. We don't necessarily know how deep such a pullback would take. I mean, look, I don't know if this is going to be the peak over the near term or whether it's just a short blip and we continue higher. If it is, then you'll be looking at a Fibonacci retracement drawn from that 35.78 and pointing towards a potential near-term pullback before the bulls come back into play. especially if the inflation data comes in under control, essentially, whether it's as expected or lower. That should be good for gold. If we break back below this 35.78, that would also mean a breakthrough trendline support, and that points towards a possibility of a wider retracement coming into play. But for the near term, any short-term downsides are likely to be brought up, in particular if the inflation data comes out weak. Then looking at the US dollar, this is the dollar index, and you can see here that we've broken out from this period of consolidation, and then we've sort of been gradually moving higher. We sort of saw a decent surge in July there, but by and large, we're now in this sort of sideways phase before we, in my mind, likely head lower once again. Now, you could say that we broke out from this pattern of lower highs, lower lows, but we also sort of see the intraday swings and then the wider swings. That looks to me like a retracement of this wider move lower. And so, yeah, it's coming to a 61.8, heading lower. Certainly greater confidence for me on the bearish side of things that phase is over. Comes with a breakdown through 96.663. For now, we're around a key area of support, which is around this sort of 97 mark, just above that. And we're trying to break through that level. I think there's a good chance that we do see this rollover. And in particular, if we see weak inflation data coming out this time around, it emboldens the doves, it emboldens the dollar selling pressure, and it pushes the likes of gold in all likeliness towards the upside. Now, what's interesting here is that when it comes to stocks, it's not necessarily always a given exactly how we're going to see it respond to different movements in terms of rate expectations. And you can see that here, right? So by and large, we're not necessarily looking at a super clear-cut positive correlation because we sell off here, so lower yields and lower equities. Okay, fine. Then when we rise in terms of equities, we essentially flatline and then start to sell off just as Nasdaq's moving higher. So we'll get the inverse correlation on this phase. Inverse correlation there. So this is rallying, this one's selling off. This one's selling off, this one's rallying. So we've been seeing inverse correlation. And then you can see here, most notably last week, that big move that we see selling off, rallying. And so this now means that we're moving into a phase where at the moment, markets perceive lower rates, which the 2 years are a good gauge of exactly where markets perceive rates to be in terms of monetary policy. Lower interest rates are perceived to be good news for equity markets once again. And therefore, if we do see inflation under control, I'll be expecting further upside to come into play here for the Nasdaq. Near-term resistance should be looking up at 239.66 following this breakthrough, 237.26. From a wider perspective, you can see that this essentially means a breakout through resistance and into fresh highs once again. The trend is very clearly your friend on this chart. And so as long as we remain in that bullish pattern of higher lows in particular, does signal the high likeliness that the bulls are going to continue to dominate here and signal a potential push up into record highs. As you can see here, pull back into the 76.4 fib here, then rally, but it's an ABC style retracement or move higher because we don't necessarily have that initial move through resistance, and now pushing higher. In my mind, it's likely we're going to see the bulls remain in charge. What's it take for the bulls to remain in charge? Well, weak or at target inflation data. If we see it coming in hot to a significant degree, then yeah, it could undermine things right now. But markets are very convinced that this is going to be a case of data that really plays into the narrative and builds on the idea that we're going to see rate cuts from the Federal Reserve. The Fed seem quite confident that they're going to need to act, and therefore I think that should be beneficial for the Nasdaq. Of course, the caveat here is if we see a really significant spike in terms of inflation pressures, it could see sentiment start to sour a little bit for the likes of the Nasdaq. I hope that's been useful. Make sure to like, subscribe and follow for more. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading.